Welcome to Odisal Associates,
Accounting and Finance Tutors. In this episode, we are going to look at the basic of accounting. Somebody told me that for me to go into account, deep side of the account, that I should talk about debit and credit first. So I have decided to throw light on debit and credit. As a person, when I started doing accounting, I found it difficult to understand debit and credit because it was not what I knew before. It was when I started doing accounting that I started getting confused on what they were talking about in debit and credit. So we're going to look at debit and credit. Debit and credit are the two fundamental aspects of accounting. As simple as the words may be, and as commonly used as the words may be, they are the two most difficult words to understand in accounting. The job of the accountant is in debit and credit, to debit and to credit. After all the calculations, it ends up in debit and credit. If we know what to debit and what to credit, we should have solved more than half of the problems in accounting. There are some calculations you may not need to do if you can debit and credit correctly. All you need to do is debit, credit, and balance your account, and the amount will come out as a balancing figure. What is debit? Debit is increase in assets, expenses, and decrease in liabilities and equity and income. Let me just illustrate it here. This is asset and expenses. This is liability, equity, and revenue. Let the arrow that goes up indicate increase, and the one that comes down indicates decrease. So this is assets and expenses. And if it increases, you debit. This is liability, equity, and revenue or income. If they reduce, you debit. So this is the definition of debit. Increase in assets and expenses, and decrease in liability, equity, and revenue or income as the case may be. So in this case, there is an increase in these two elements of accounts. And in this case, there's a decrease in these three elements of account. And that's what debit is all about. Examples: receives cash. When cash is received, it means that asset has increased. You debit cash account. Two, purchase goods for sales. It means that expense has increased. You debit purchases account. Three, settle a creditor. What it means that liability has decreased. Liability has come down. You debit liability account. Maybe payable or non-current liability, as the case may be. Four, pay dividend. When you pay dividend, it will affect equity equity will come down. Debit retained earnings accounts. 5, refund, cancel, or reverse accrued income. Income has reduced. That's revenue has reduced. You debit revenue account. What is credit? I am just going to define credit the other way that I defined debit. So in this case, credit is decrease in assets and expenses and increase in liabilities, equity, and revenue. So in this case, this will be increasing while this will be decreasing. So this is credit. Let me rewrite this. Assets and expenses. Credit. Credit. Examples. 1, disposal of PPE. When you dispose an asset or sell an asset, what it means that asset has decreased. You credit the PPE account. 2, refund of expense. When you refund any expense, expense has decreased. You credit the expense account. That's this. The first one was this. 3, purchase of goods on credit. When you buy goods on credit, what it means is that you have created a liability because there is a supplier that you must pay. So what it means that purchases has increased, liability has increased. In such a situation, you credit the liability account because there is an increase. Issue of ordinary shares. When you issue ordinary shares, it means that your equity has increased. You credit equity account. And 5, sales of goods. When you sell goods, you have increased your income. And when you increase your income, you credit the revenue account. Debit and credit formula. Debit is equal to credit. This is what has been. According to the double entry rule, every transaction must have a debit and a credit side. The total of debits must be equal to the total of credits. That's what the trial balance states. I am trying to explain this in a way that I will not use accounting jargon so that even a layman will be able to appreciate what debit and credit means. Debit and credit rules. I'm going to look at the 5 elements of account in order to state the rules of debits and credits. We take assets first. To increase assets, you debit the asset. To decrease asset, you credit the asset. So anytime you want to increase your asset, you debit it. Anytime you want to decrease your asset, you credit it. So that is the rule. Now, every asset, all things being equal, should have a normal debit balance. The normal balance of an asset is a debit balance. When an asset is having a credit balance, there is a problem somewhere. The posting might have been wrong. If not, it's not supposed to be credit. Why? Because you cannot give what you don't have. So if your asset is zero, you cannot release any asset. It's only when you have something in your asset that you can give out. So it's either the asset account should be zero or should be uh, debit. There is only one asset account that might be credit, like a bank, because you can get overdraft. If not, every asset account has a normal balance of debit. Then we talk about liabilities. To increase a liability, you credit the liability account. And to decrease a liability, you debit the liability account. Remember, the arrows are talking about increase or decrease. So that is liability account. If you must increase your liability account, you must credit it. If you must decrease your liability account, you must debit it. And for liability account, the normal balance is credit. So every liability account should have a credit balance and not a debit balance. The same reason that we have for asset account to have debit balance. That's the same reason we have for liability account to have credit balance. We talk about equity. Equity is in the same line as liability. To increase an equity, you credit. To decrease an equity, you debit. And the normal balance is credit. Here is normal balance. Is credit. The same goes for revenue. Revenue or income, equity, and liabilities, they share the same attributes. To increase revenue, you credit, and to decrease revenue, you debit. This is increase, this is decrease. This is increase, this is decrease. This is increase, this is decrease. And the normal balance is credit. This is in this place, this is increase, this is decrease. This is normal balance. Okay, expenses share the same attributes with assets. I'll clean the asset and put expenses, and it will just be the same thing. To increase an expense, you debit the expense. To decrease an expense, you credit the expense. And the normal balance is debit. So these are the rules of debit and credit. We have to emphasize that understanding debit and credit is essential for keeping accurate financial records. We'll give some illustrations. Assets, purchase of office equipment. Transaction, purchase office equipment for 100,000 naira cash. Here, the debit office equipment with 100 naira and credit cash with 100 naira. In this case, office equipment has increased. That's why we debited it as asset. And cash has decreased. That's why we credited it as an asset. The two of them are assets. Now, they are in the same class of balance. If two accounts are in the same class, for them to complete the double entry, if one increases, one has to decrease so that they can complete the double entry. It is the other way around. If they are in two different class of account that had different balances, if one increases, the other one will also increase in order to complete the double entries. We look at liability, borrowing from a bank, transaction, borrow 500,000 from a bank at 10% interest rates. In this case, you debit cash 500,000 and credit loan 500,000. This is because cash as an asset has increased. You have debited it, as we said, and loan as a liability has also increased, and we have also credited it. That's why I said that if there are two different accounts that have different normal balances, that the two must increase or decrease for the double entry to complete. In this case, you have seen that cash has increased and loan has also increased, and the double entry has been completed. You debit cash account because it has increased, and you cash being asset, and you credit loan account because it has increased, loan being liability. Equity. Equity, issuance of shares. Let's look at issuance of shares. Transaction, issue 10,000 shares of 10 naira each to investors. So this will yield a total of 100,000, 10,000 times 10 naira. In this case, you debit cash, 100,000 naira, and credit equity or ordinary shares, as the case may be, ordinary shares, 100,000 naira. In this case, again, we have seen that cash is asset. It increased, we debited it. Equity has also increased by 100,000, and we have credited it. These are two accounts that are of different normal balances. So the two must increase or must decrease to complete the double entry. Revenue. Revenue. Sales of goods. Transaction. Sold goods to customers for 80,000 naira cash. In this place, cash has increased. As an asset, you debit the cash with 80,000 naira. And we know that when you sell goods to customer and he pays cash, the next account I'll take the double entry is sales. And sales, as we said, is a revenue account. It has increased. So we'll credit it. Sales, 80,000 naira. You have also seen that cash and sales have different normal balances. So because of that, they are directly related in their increase before we debit and credit. Expense, payment of salaries, transaction, pay salary to employees for 30,000. The expense we are using here is salary. So when you pay expense with cash of 30,000, what it means is that there are two accounts that are of the same normal balance: cash and salary. So one must increase and one must decrease in order to have double entry. So we say debit salary, salary expense, 30,000 naira, and credit cash, 30,000. Now we have seen how we can use the word debit and credit. It's not like the normal usage of debits that we know, but specifically for accounting. I have tactically dodged to treat double entry and avoid computations that will complicate this. So that first and foremost, let's know what debit is and what credit is. We've seen that in all, debit we have seen to be the increase in assets and increase in expenses. That's purely what is debit as far as account is concerned. If there is an increase in asset, if there is an increase in expense, then the entry that the accountant will enter is a debit entry. So the other way around, when we talk about liability, equity, and revenue, for us to debit them, they must reduce. So when they reduce, we debit them. It therefore means that we have debited. That is the definition of debit. Look at it as increase in assets, increase in expenses, decrease in liability, equity, and revenue. Then credit is the opposite of debit. So since debit is increase in assets and increase in expenses, credit will be decrease in assets and decrease in expenses. The same way, credit will also be increase in liability, increase in equity, and increase in revenue or income, as the case may be. Let us take note of this, that if a transaction involves the same class of account that has the same normal balance, one must increase in value and the other decrease in value to achieve a double entry. Otherwise, if it involves different classes of accounts with different normal balances, the two accounts must increase or decrease at the same time to achieve double entry. So I think this is a very simple way of understanding debits and credit without confusing anybody. If we have this as the bedrock of accounting practices, it will be easier for us to understand more complicated accounting issues. We must know what debit is and what credit is to be good accountant. Thank you for watching. Subscribe, follow for more episodes.